Hello, all. I hope you're doing well today. Now we're going into the next module, module 15, which is so much fun, and I think you'll enjoy it. Okay, let's go ahead and get moving and share my screen. And we are now module 15, personal finance. And let's take a look at the objectives and overview here. Identify the social and economic impact of entrepreneurs in society. And so we'll see how the personal finance will tie into this. We have our module level objective here, and then we have some activities that we're going to be doing. And then we have the only assignment that we have here now, we're reaching the end of the course, is just to add the information from module 15 to our exam review sheet. Okay, so let's go ahead and take a look and see what we're doing now. And you'll see why it's so much fun. So creating wealth resources. Now, we all want to create wealth, don't we? I mean, it's important for us to have a certain amount of wealth to be able to live sustainably, to sustain ourselves as people in society. So we'll take a look at those resources here. And I have a really fun creating wealth video. And it is about the richest man in Babylon. And this came from a series of books there. And I read this book many, many years ago, and it changed my life. I really made specific changes in my life to focus on saving, and it made an extraordinary difference in my life. And then what I'd like you to do is, after watching that video, is go ahead and download this example budget template. And you will see what it's really just, let me see if I have it. I do have it downloaded here so I can show you. What it is it just shows you the months of year. Now, this was set in 2019, but you can change that to whatever works for you. Customize it, please. And then you would put in whatever your income is per month. And then if you have any other income, you would include that as well. And then you have your net pay in here. Now, you have your gross pay, but then don't forget, we're looking at net pay. And I will show you how we're going to go about that. But you want net pay in here, that the take-home pay, right? After all the taxes and benefits and anything else that's taken out, what do you have left over? And then we can look at the expenses. Maybe you have a rent that you pay, maybe you have a car payment, you pay for your own groceries, you have other expenses mixed in there, and you can put those in, you can customize this list however it pertains to you, and then start filling it in. So here we are in June. You can just start, okay, I'm going to start in June, and then start from June and move forward. So you have, half of a year to start with, and then next year you can start with the full year. But go ahead and get started on it, because it does make a big difference. And the main part of this is to actually focus on savings. You want to be able to have savings. So you want to see, what are my expenses and what am I saving? Actually, I prefer to move the savings up here. So you have income, you pay yourself first, and then you have your expenses. But we all know we have to pay those expenses. But you want to budget for savings as well. And then you want to set some goals for spending and for savings, and you can include that information in here. And the Excel spreadsheet is set to automatically calculate for you, and it will tell you how much of your income you spend and how much of your income you save. So in this scenario, if you save $350 a month, you're saving 18% of your income, right? And it is your net income, because it's really what you take home, right? So that's important. All right, so please utilize that. I think you will find it helpful. All right, let's go ahead and get back into the module. And now we're starting with personal finance. Then we're going to go to the next slide deck, which is creating wealth, which is so much fun for me. Okay, so let's go to personal finance to start with and go through that slide deck. So, we want to be ready for financial savings and taking care of our financial readiness at any point in time. We can start it now. We don't have to wait to be sure that we are ready. And we want to be sure that we have financial intelligence as we're moving forward. So what are some of the things that we need to think about? We need to think about budgeting, your earnings, your spending, investing, donating, and saving. So those are the areas that we want to focus on when we're focusing on our own personal finances. You know, managing money for business really starts with managing your money for yourself. If you can manage the money for yourself, you can manage money for a business. But please take the time to devise a budget sheet for yourself to make sure that you're in good financial standing, and then it will become very easy for you to do this for a business. So let's just talk about accounts a little bit. We have different types of accounts. We have a checking account, savings account, money market account. Not too much is left in money market accounts now, but as interest rates creep up, I think that will become much more popular. Even savings account. I mean, I have a savings account. I have money parked there, but it's really just a small amount of money that I have just to have cash on hand if I need it for something. The rest I have invested, and you can invest in maybe a certificate of deposit, which is very low interest rate right now. It is not popular. It was years ago when we had high interest rates, and it may become popular again as interest rates start to increase. An IRA is a individual retirement account. So when you're running your own business and you don't work for someone, you would want to have an IRA and put money into an IRA so that you have money saved for your retirement. Now, when you're working for someone, you would probably have a 401k or some type of retirement savings, hopefully, from your employer. And that is very good. And when you leave your employer because you're so successful in your business, you can convert that 401k into an IRA so that you would have your own individual retirement account. So the beauty of that is when you convert it to an IRA is that you have more control over your investments. With a 401k, you're limited to what the provider offers, and usually mostly mutual funds. For the most part, there are some others that branch EFTs and some others that branch off from there, but most of them are mutual funds. Okay, some mutual funds can be very good. There are some mutual funds that are fixed to indexes like the S&P 500, which has been very fruitful over time. But there are indexes that can be very useful to park your money in without having to worry about buying individual stocks or equities. Some other bank terms, you know, you have a deposit and a withdrawal from an account, mobile banking. I love mobile banking. I don't have to go to my bank anymore. All I do is take a picture of a check when I receive it and deposit it. And it's wonderful. And I can transfer monies from maybe my Schwab account to my Chase account. And I just write a check to myself and I just take a picture of my check. Boom, it's there. And I don't have to worry about transfer fees for transferring from one account to another because all I do is take a picture of a check and deposit it. So that's pretty, I love mobile banking. It's wonderful. I pay my bills mobilely. Everything's just paid automatically so that I don't have to worry about paying my bills or being late on anything. So transferring, so I like to transfer money too, like within an account. So I have a Chase account, I have a savings account and a checking account. And so I sometimes will transfer money from one to the other. And usually I have my paycheck go into my savings account because I want most of my money to be there. And then I transfer money from my savings to my checking each month, a set amount that I know I want to for my expenses. And then I take out another large chunk of that savings and transfer it to my Schwab account where I have investments. Now, overdraft fee is another thing, you know, like if you don't have enough money in your account, then you will be assessed a fee. If you write a check, you don't have the money in there, sometimes you'll be assessed a fee unless you have it tied to a savings account where you have money there that they can take the money from the savings account. But you want to be mindful of the monies that you have at every given time. You know, what's so important is to respect money. It shouldn't rule you, but you need to respect it and understand it for what it is and how that it can help you in your life. Let's talk about FDIC. It's the Federal Deposit Insurance Corporation. So what you're allowed a certain amount to be covered with FDIC, and we also had FSLIC for savings accounts, but there were very few savings banks left. And so now mostly all commercial banks are covered under FDIC and not FSLIC. There may be one or two small savings banks around that still have FSLIC. So, but what it does is it insures to up to a certain amount of money. So you want to be careful not to go over that set amount with one bank because then your money is not protected. Here's just an example of a deposit ticket. I don't even fill these out anymore because now it's, mobile banking makes life so easy. You take a picture of the check and you deposit it electronically. I want to talk about simple interest and compound interest. So here, if we look at a savings account and very simple interest here of, we have opened our account with $10,000. We have 5% interest in this account. Now they're not really paying 5% now, but probably soon, very soon with the increase in interest rates. And then so then at the end of the year, we have that 5%, then we have 10,500. We have the extra 500 in there now. So now, at the beginning of the next year, we have 10,500. The interest rate on the interest adds up to another $25 a year here, as we can see, right? So that has added on here. And so what's happened here is because we have the 500, we've added another 525. Now we're at 1,125. And so this is a compounding effect where we're being paid interest on top of interest. And so here again, year 3, now we wind up with a little over 11,500, which gives us a total interest. Instead of 500, 500, 500 simple interest, we have a compounding effect of paying interest on top of interest. And in a very just short 3-year period, we have another $76.26 here. And you can imagine how this can really, build over time. Here's some formulas. If you're interested in that, you can go ahead and knock yourself out by going through that. But here, let's have another visual example of compound interest. So here, if we have just simple interest over the 30-year period, starting with 8% for, it was $100 started here. And so we have $100 started in year 30, we would have earned $340 as opposed to the 8% compound interest gives us over 1,000. So we can see this is very little money over a period of time, but we can see how much more money we can have. Now just let's, expand that over what would really be the case. You wouldn't just be putting $100 away for 40 years, you'd be adding to it over and over again. I'm going to show you some examples of that as well. So we want to consider investing also, because yes, it's fine to put some money in a savings account. And once you have a certain amount saved, you want to be able to put it into one of the very best suggestions from many financial analysts is to have an index fund instead of worrying about specific interests. Another thing that's really helpful for long-term savings is to have an annuity that is specific annuities that are low-cost annuities and that are set so that even if the market goes down, your portfolio, your monies do not go down. Okay, they still continue to increase even if the market goes down because they're insurance holdings. So annuities can be very helpful in the long term. But here are some companies that you can consider using for investing, where if you want to do some trading on your own, you have an idea, you think something will do well and give it a try. So Ameritrade is one, Fidelity Investments, Edward Jones is another very conservative investor to help you so you don't lose your money. Charles Schwab, which I use, I think is very good, no cost trading and lots of free advice. But let's break down a paycheck. Let's look at if you get your paycheck and let's take a look at it. So I've shown this to students in the past, and students that have just started working for the first time. Wait a minute, what happened to all that money I made? I lost like 28% or 30% of my paycheck. How can that be? Well, let's see what happened there. So we have certain terms that we're going to use, like, you have your pay period. Let's look at it at an example here. Here's our pay period. This happens to be December 16th through December 31st, a 2-week period. So that's our pay period. This is when we're being paid for. That could be the same date as the end date, or it could be after that end date. We have gross pay versus net pay. So we have, like in this example here, we can see our gross pay is $3,837 and change. And then we have our year to date. This is towards the end of the year. And then if we go down to net this check, it's $2,581 and change. So you can see a huge difference over the 3,837. We're down to 2,581. And so what happened with the rest of that money? Well, it went here. It went into taxes, and perhaps if you have some type of savings account, if you have a 401k and you contribute to that, that would also be included here, and there would be more money taken out. But that is the difference. Your net pay is 2,581 as opposed to the gross being 3,837. So it may sound like, wow, I'm making really good money. It looks like the person's making almost $90,000 a year here. Great money. But what are they really taking home? A very different amount. Let's see if we look at the 2,581, and it looks like 26 pay periods, only $67,000 a year. So it's a big difference. It's almost a third of the monies earned go to taxes. And then if you have a 401k, then there's more money taken out. So that is life in the United States, and we have to deal with that, right? So we have federal income tax, we have Social Security, Medicare, right? That's FICA is considered Medicare and Social Security taxes. So hopefully Medicare is something that will be available when you retire, so that you wind up, it covers 80% of your medical expenses, the other 20% you're responsible for. Social Security, hopefully it will still be in existence when you are ready to retire and to start collecting Social Security. And then those funds will be available to you if you have paid into the system for a certain amount of years and a certain amount of money. But it's taken out regardless, right? So it is taken out of everyone's paycheck, whether you are going to collect from it or not. And then let's say, maybe we have some pre-tax benefits, health, vision, dental, that sort of thing here. We don't have any in here. We do have some. This is California, so we have additional taxes in California. There is California income tax that's taken out, and a state disability insurance that is taken out as well, that the employee pays rather than the employer in California. So those are, looks like another almost $300 a month for the California taxes. We're in Florida, so we don't have Florida state tax, which is a good thing for us, right? So we bring home a little bit more money in our paycheck for spending and saving. All right, and then we have certain tax forms. We have a W-4. W-4 is the form that we complete when we're hired to let the employer know how many deductions we want for tax purposes, for federal tax purposes. So they know how much tax to take out of each paycheck. So if I claim one dependent, they take X amount of dollars because I'm claiming just myself. And if I have children and I have 2 children, I claim 3 dependents, myself and the 2 children, they take less taxes out because I will wind up paying less taxes at the end of the year. So the W-4 tells the employer how much to take out in taxes based on the amount of your dependents. We have a W-2 form, which is a form that is provided to us at the end of the year that breaks down all of this information, our total pay, all our taxes that we've paid, and our net pay at the end of the year. This is just the last year pay stub. It's not a W-2, it's just a pay stub. But the W-2 is a separate form, has more information for federal tax filing purposes. And in this case, state filing with California. And what we do is we take that W-2 form and we fill out our tax return. We can pay someone to do it for us, or we could do it ourselves, follow the instructions. It's a little cumbersome, but it can be done by yourself. Many people do their own taxes. And you can file those taxes. And even there is, if you've made less than a certain amount of money, it's a few $1,000s, you don't have to file a tax return at all. But after a certain amount, you must file a tax return. You may not have to pay taxes, and you may get a refund under a certain amount of income. So in some cases, all those federal taxes that you've paid, depending on the amount of your income, you may get all or most of that back. Other cases, if you have other investments, if you have like dividend income investments, if you buy and sell real estate property and you've made income from selling property, flipping property like I do, then you have to pay tax on those monies. And no matter how much you paid in here, if you have a lot of dividend income, interest income, and other capital gains income from flipping houses, you are going to be paying more income tax. That's just the way it is. Federal income tax, that is. Okay, so let's move on. In this case here, 67% of salary after deductions. So yeah. All right, so let's look at using debit and credit cards. One thing I want to mention about debit cards is that if you lose a debit card, or if it's stolen and someone uses that debit card, sometimes it may be difficult to get that money back. It's money taken out of your bank account. And as opposed to a credit card, if a credit card's stolen and someone charges on that credit card, as long as you address it within a reasonable period of time, you call the credit card company and they will freeze the credit card, and then you will not have to pay that. So I tend to use a credit card. I don't like to use a debit card. I only use it certain times when I travel, because when I'm out of the country and I need to go to an ATM to get cash money in that country's currency, then I use a debit card, but only for that purpose. I never use it to purchase anything locally at stores. I use a credit card. Plus, what I like about the credit card is that I get points, and that turns into money for me. So I get paid for using my credit card, which I like. So that's extra money. So I'm looking for little buckets of extra money here and there that I can add to my pile of wealth, right? So that's what I'm focused on there. So I always pay my credit card at the end of the month. I never, ever hold a balance, ever. It's always completely paid off. And so please discipline yourself to do the same thing. You do not want to run a balance on a credit card. It can be extremely costly. The interest rate is so high. All right, but if you pay it off at the end of the month regularly, then you will be benefited and you will be paid to have that credit card by extra points. And I always like the cash points credit cards. And sometimes you can open a credit card and get money just from opening the credit card. So, which is a good thing as well. So here's some things to consider, right? So I mentioned what happens between the difference between a debit card and a credit card. So who pays in a certain situation. Sometimes you can get money refunded if a debit card is stolen and money is taken out, but sometimes you cannot. So you have to be very careful with that. Sometimes a debit card is better for you if you cannot discipline yourself to pay the credit card at the end of the month. And then you keep running a total. Well, then, you know what, cut up the credit card, don't ever use it again, and start using a debit card until you can discipline yourself again and then get yourself in a position where you're having the credit cards work for you instead of you working for the credit card. All right, so I mentioned the personal security. Credit cards are more secure than a debit card, a little bit more safe. They also, credit cards, unlike debit cards, help you establish credit, right? So with the credit reporting agencies, they usually have limits, and that's okay. It's based on your ability to pay. Here's an example of a credit card statement that breaks down the information. And if you pay it all, then there's no interest. If you don't, then there is interest. Credit limit, paying on time each month, making sure you pay that balance on that due date. Now, I have my credit card set up that the money's automatically taking out of my checking account each month on the due date. I have it set up that way, and I make sure that it's completely done every single time. And I don't even have to think about it. All right, so here are just some statistics. A percentage of Americans with revolving credit cards debt, carrying the debt, is 38%. Sadly, 38%, which equates to about $5,800 per person. That is a lot of money, and it's a lot of interest going to the banks. Those people now, you may say, well, without those people, how do I earn my money from my credit cards? How do I get my points? Well, I get my points from the processing fees. The retailer who offers credit cards have to pay a processing fee, and that's factored into the points that people like me who pay the credit card on time get that money back. Yes, this is also part of the equation, but I would like to see certainly everyone in this course not holding a credit card balance ever. So if you do have a credit card balance, cut up your card, don't ever use it again until you've disciplined yourself to be able to pay off that balance at the end of the month and never run a balance. Okay, so let's just take a look at a scenario here. If you do hold a balance, here, $5,000, that's a little less than what the national average is. Interest rates at 9.9, that's fairly low for most interest rates on credit cards. And then the expected monthly payment, what they expect you to pay, is $100 a month. It's going to take you 65 months to pay that off. My goodness, that's a long time. And you're paying $1,500 in interest. But let's look at a scenario where it's more like what the credit card interest rate is really like, which is about 19–20%. And you're still paying that $100 a month. It's going to take you 108 months to pay it off. And now you're paying a whopping $5,700 in interest, more than what you have charged. Okay, so you can see why it makes no sense to run a balance on a credit card. If you can't afford the item, just don't buy it. All right, we have loans. Let's talk about loans a little bit here. So we get bank loans. The bank is the creditor. The entity that's issuing the loan is the creditor. And we can look at APR versus APY. So the APR, when we take out a loan, is the annual percentage rate. And it's factored in with if there's points or any other fees attached to that loan, it's factored into that annual percentage rate. And so we can see what that is. Now, the annual percentage yield is not as it relates to a bank loan, it relates to investment. You want to know, well, how much is my yield? How much do I earn rather than how much do I have to pay? And then we have the term. What is the term? Is it a 5-year bank loan, like maybe similar to a car loan? Or is it a mortgage where I'm paying 15, 20, 25-year, 30-year mortgage? The term is the length of the mortgage. We pay principal and interest in our payments each month on our loan. And then we usually have some type of collateral attached to the loan. Could be a car, could be a house, property, and so forth. Equipment, but on a personal level, it's typically a house and a car. A co-signer may need to sign for you if you have not established credit as of yet. And so, but then they are responsible for you paying back that loan, which can be dangerous. And it's something you want to be very careful about doing for someone else. When you take out a loan, especially a bank, a mortgage, you will typically receive an amortization schedule that shows you the entire schedule of every payment that you make over, let's say, a 30-year mortgage. It shows every payment over the 30-year mortgage and how much gets paid down each month, how much is paid to interest, how much is paid to principal. Incidentally, I just want to go back to that for a moment. Mortgages, because I was in the mortgage business for many years. I was a mortgage banker, and I processed mortgage loans, and I used my own funds to fund the loans, and then I would sell bulk packages of loans to investors. So I know quite a bit about mortgage and mortgages. So one thing I want to say about, if you want to get a mortgage, you can, if you want to buy like a bigger house or a more expensive home, oftentimes you're better off getting a 30-year mortgage, but you can pay down that mortgage in far less time if you just do one thing. If you, at the beginning of every year, and starting with the very first payment, is pay one extra payment towards principal, right? So you say, this is not an extra payment, this is payment towards principal only. So it goes towards principal, does not go to an actual payment towards, and does not apply to interest. And if you do that, just one a year will bring down your mortgage to 17 years from 30. Big difference. Some people can't, discipline themselves to do that, but I can tell you I've done it, and it is remarkable how fast you can pay off a mortgage by paying down additional principal early on in the mortgage. Another way that some people do is just pay, if they have, let's say, $1,000 mortgage payment, principal and interest, they will pay maybe $200 extra every single month towards principal to pay down the mortgage, and that will take years off the mortgage as well. Now, some people say, well, it doesn't really matter. I'm not going to be in the house 30 years. I'm going to wind up selling the house after 3 or 4 or 5 years, and then buying another one. Well, maybe not now. We'll see what happens. But it's still a way to not have to pay high interest. Now, if you have a low interest mortgage, wonderful. That's fantastic. And now my son and daughter-in-law bought a home when interest rates were rock bottom, and they are not moving for a long time, especially now with interest rates increasing. I'm going to show you schedule 2 about how the interest rate on a mortgage can significantly change the payment. All right, so now let's take a look at car loans, right? Because most of us get a car loan. Some of us don't. Some of us buy used cars and just pay cash. But let's just say we're buying a used car and getting a car loan for it. We're going to get a 2010 Honda, $8,800, and we have no trading value because we're not trading in a car. We're just getting our first car, and we're putting down $500 as a deposit. We managed to put that up in savings, and now we're good to go. We need to finance. We're financing at a low interest rate, 3.9%, over 36 months. So what are we paying? We're paying $245 a month. Now, let's say that we extend that 36-month car payment to 48 months, right? So what happens here, we're still paying the $245 a month, but instead of paying the $88.20 in total payments with an additional $510 in interest, we're paying $89.67 with an additional $678 in interest. So we can see when we add time to a payment, the amount of money spent adds up more. It's not a better situation, it's a worse situation for the amount of money that you spend. So all right, some special loans or special information as it relates to loans. So we have the approved amount versus the affordable amount. So we have, let's say we go for a mortgage, let's say we're house shopping and we want to get a pre-approval letter from a mortgage company. So we go to Chase or we go to any of the mortgage lenders and we want to be pre-qualified. They will run a credit report on us. They will look at our pay stubs over a certain period of time and see usually 30 days, sometimes 45 days. and they will give us a credit and income approval, which is based on an appraisal of the property. And they will say, okay, this person is qualified for X amount of dollars to purchase a house. And then you can use that as leverage when you want to purchase a house and have a mortgage because you can't pay cash. All right, so that is the approval amount, is the amount that you're qualified for, but how much you can afford is up to you. That's your decision. All right, now we have the interest rate in the term. I mentioned the interest rate. We know, it was down like 2.9% at one point. It's gone up, steadily creeping up. I think it's gone up today. As a matter of fact, we're going up today. And the term is the length of the time of the mortgage, 15 years, 20 years, 25, 30 years, whatever it may be. There are some extra fees that you need to be considered, and oftentimes they are added to the loan. Some lenders require the escrow of funds for taxes and insurance, both taxes and insurance. They make you pay a year's worth of your insurance payment, and then they still charge you every month. So you paid a whole year in advance, and then they still charge you every month to make sure that you have your house insured. All right, and then, which I don't like, so I prefer to not have it escrowed, and I pay my own insurance payment. I pay my own taxes because I get a benefit by paying my taxes at the November date, and I pay them all off at that date. So there's no extra charges at all for my taxes. I pay my HOA when it's due, the date it's due, and then the same with insurance. I pay the insurance, and then I don't have to have any escrowed funds. But there are extra fees that you need to consider, and as far as qualifying for a mortgage, the taxes factor into qualifying, the HOA fee, if there is one, if there's any type of a development fee, that's involved as well. And then you have those escrow accounts, as I mentioned. PMI, so private mortgage insurance. If you want to borrow more than 80% of the purchase price of a house, then you would have to pay private mortgage insurance. That's an extra fee that's on top of your regular principal and interest payment. Now, some lenders have gotten savvy, and what they will do is say, well, after so many years, the PMI will drop off. Others say, no, you have to provide us with an appraisal that your property now is worth more, that the mortgage balance is less than 80% of that value, and then they'll take it off. But then there's an expense to that. You have to pay for an appraisal, and then there's all sorts of, then there may be a processing fee for that. Okay, now there are other types of loans out there. FHA is a very good loan that if you have very little money and you really want to get into a house, so you own your own home, they will lend up to 97% of the value of the house. It has to be a certain amount of money, under a certain amount, but it's fairly high. You can purchase 1 to 4 family homes. 4 families can be multi-families can be very good because you can earn money by renting out part of the house and live for free, which is ideal for someone young getting started in real estate. There are subprime loans where if people have poor interest or credit, they have poor credit. There are these very high interest rate loans that can be obtained, but the interest rate's very high, and sometimes they have prepayment penalties as well, that if you decide that now I've reestablished my credit's good now, I want to refinance and get another loan, they sock you with a fee because you have a prepayment penalty. You paid it off before the end of the term. You can refinance a loan perhaps too, if you want to pull cash out of it. And then of course your payment would increase depending on the interest rate. A HELOC is a home equity line of credit. And that is something good to have in place as a business owner. I mean, you are jeopardizing the equity in your home, but what you've done is you have availability to cash if you need it. And you only draw down on that if you need the money. And so it's this nice line of credit that's available for you. You can draw it down if you need it, pay it back when you have the money, and then when you need it again, you can draw again, pull money out, and then pay it back. So it's a nice place to have to go to if you need money. Now, oftentimes the HELOCs are based on interest only. So you're only paying the interest, you're not paying any principal whatsoever. So you need to keep that in mind. And then there are many other types of loans as well, but this is a good start. So here's an example of like buying a house. You have a mortgage amount of $250,000, a 30-year mortgage term. That means that you have 360 payments, right? And then your interest rate is 4.5. It's a little higher than that now, but you can calculate to see, well, what will my principal and interest payment be? And they're all over the internet. You can find this easily. And then you can see in this particular case at 4.5%, it's $1,266 a month. Now you may look at that and say, wow, you know what? I pay more than that rent. But then don't forget you have interest, you have taxes, you have insurance, and if you have an HOA, you have to add that fee on as well. So let's look at a scenario here where another scenario similar, right? So we have $250,000. Let's see, we have a home purchase after down payment is $250,000, 5% interest. So we're mortgaging the $250,000 over a 30-year period. And we can see that we have mortgage insurance, PMI, right? Because it's over 80%. And then this particular case is like, well, we're limiting it. We're only going to charge you the PMI for 83 months and then it falls off, which has become very popular with banks lately. Here's the amount of the mortgage insurance, the PMI, and then that will go away after the 83 months. It's a long time. And here is your final payment, $1,800 a month. So you can see what we're paying. We're having this over a long period of time, 30 years. We can see the original mortgage amount. The interest that we paid is almost the amount of the mortgage. So the total amount is like $483,000. Sometimes this is the only way we can go, although we can maybe make some changes along the way. And if we plan to stay in the same house, it would be worth it to try to pay off the mortgage earlier. Fine, go ahead and stay with the 30-year mortgage. Just try to pay it down sooner, down to closer to 17 years. And then you'll be so much happier at the end of that time by just having the house free and clear. Here are just one interest rate change, and we go from 5% to 6% with that same scenario, right? Our interest rate now, our total monthly payment goes from $1,821 to $1,978. So close to almost, like $180 difference here, or $160, $70 difference. We're here, but the total amount paid, look at this, $539,000 as opposed to $483. Big difference. Just that one interest rate increase. All right, so another thing we want to mention is credit score. So we have our three big players here that in the credit reporting agencies are Equifax, TransUnion, and Experian. And they, when a bank wants to make inquiry on our credit, they will pull from either two or all three of the credit reporting agencies. Rarely do they just pull from one. They either pull from two or all three. And they will see what is the credit score, which has become very popular over the last 20 years. And they also look at the credit. And so we can look at our credit score, takes into all our credit into consideration. And we can see like from age groups, like from the 18 to 27-year-olds, you can see that they fall in the 650 to 749 range, right? Where we can see it drops off. There are less and very few at the high category between 8 and 850. All right, so we need to consider that as well. What we can do, what can we do to increase our credit score rating? There are several things we can do. Is we never want to charge our credit cards up to the limit of where it needs to be, because if we do, then that drops our credit score. So we want to be very careful and mindful of that. That is a huge increase in credit score if we don't have a balance. Even if it's temporary balance that you pay off for that month, it will change your credit score that particular month. Let's talk about budgeting. So we want to take a look at our estimated earnings and our expenses. Sometimes we know what our earnings are, and that's great. We can fill that in the Excel spreadsheet that I provided to you. So go ahead and put that information in there. We want to determine a variance each month because, and we want to plan for savings for ourselves, right? And run some different scenarios. So here's a budget just for 1 month that we can pull out for ourselves to see, well, all right, so let's say we have $3,500 a month. We're a big giver. We give to charity $300 a month. We have a car fund that we're maybe savings for a car, savings, right? So we're putting away $250 for a car, for a new car. And then we pay rent at $1,000, electricity and so forth. We could see all our expenses during the course of a month. And then we have, now you may have more for fun and probably more for dining out. I don't know if $60 a month is going to cut it for dining out, right? So we may want to just move some things around and find out what works for you, right? And see what's left over. Well, zero-based budgeting is nothing left over. But what are we saving? Right now, I only see a car fund. But what about long-term savings? I don't see that here. That's something really to consider. And we're going to go over that in the next slide deck. So here, our net worth equation. What does this remind you of? This is very much like a balance sheet, isn't it? It really is. It's assets, right? Minus liabilities equals net worth, owner's equity, right? That is your net worth, personal net worth. And so we want to be sure that we add more and more to this because we want to be sure that we have, and what are assets anyway? Assets are like maybe if you own a home and you have the value of the house, you have maybe a 401k, you have other investment savings, you just have a regular savings, you have whatever is worth, a car that's worth money, whatever you have that's worth money, jewelry, some furnishings, so forth. Furnishings tend to lose value, but things that are worth money. And then we subtract the liabilities, the mortgage, the car amount. So the mortgage, the total mortgage amount, the liability, right? So the amount we borrowed, what is left on the loan at that point in time, right? Because again, this is a point in time, just like a balance sheet. And you know, what do you owe on the car today? You can always look up what you owe on a car at any particular time, and they'll tell you. And then you find out, well, what is your net worth in hard dollars? Okay, what is your worth? And so you want to grow that pile more and more to create wealth. Okay, so let's go ahead and go into the next slide deck here. Okay, and that is creating wealth. And I think this is very important. And this is a brief slide deck, so I think you'll be able to manage this. So when I talk about money, right? So money, what really is money? It's a medium of exchange. That's all it is. There's no fixation with money, right? It's just, it helps me to live a better lifestyle if I have more of it, right? So you want to create wealth so that you have that medium for exchange to get things that you want to have in your life. So how do we make money work for us? How do we have money do a job for us by creating wealth for us instead of us working for money? If I work for money, I go to work every week, I get a paycheck at the end of the week, I spend 40 hours on the job, I do that job day in, day out, I'm working for money, I'm working for that paycheck. What I'm suggesting is that you don't work for that, fine that you work for a paycheck, but we need to find out an alternative plan of having money work for you instead, having money work like all these busy workers, having that work to build your wealth. How do we go about doing that? It's so simple. All right, so we have two scenarios. We have two couples, two different couples. They each bring home $5,000 a month. And what they do here, so 2,500 each, let's just say, and they pay their bills. This couple here, they pay their bills. They buy new wardrobe every season. She likes Louis Vuitton shoes and Chanel clothes. He buys expensive clothes, Amore clothes, or whatever, very expensive designer clothing. They get new cars regularly. So they're buying very expensive, either lease cars or buying cars, but expensive cars. They like nice stuff. They buy a lot of stuff, right? They buy good, expensive wine. They like jewelry and they spend a lot of money. They live a very lavish lifestyle. They are looking good, right? But let's look at this other couple. And you can see them, they're very intense here. Look at this couple, how happy they are. What they're doing is they're making the same amount of money. They pay their bills just like this couple, but they put limits on their living expenses. They have a used car that they drive and they're happy to drive it. They live a frugal lifestyle. And instead of having no money to save at the end, as this couple over here, they pack away 50% of their income into savings, right? So they're looking poor while getting rich, and that makes them very happy. Now, do they really look poor? Not really. No, they live a frugal lifestyle. They dress nicely, but they're very affordable clothes. And you can find affordable clothes in many places that they look great. They may look even similar to designer clothing, but they don't cost that much. They're just a fraction of the cost. And they go to the dollar store and get their sunglasses, right? $1 a pair. Hey, if it gets broken, $1, I'll buy another pair, right? Instead of getting, Ray-Ban sunglasses over here, they are very frugal with their spending. So they made the expression looking poor. They're really not looking poor, but they just don't look as good, but they're getting rich while this couple's going poor. Okay, so big difference here. Let's just take a look at this investment over time. In a 20-year period, if you had put away that $2,500 a month that couple two, the happy couple, had done, they would have, after 20 years, over $1 million. That's quite a bit of money. Here's a link here if you want to try this for yourself and see what you would wind up with. But now let's look at it over 40 years. So if you start young and you start putting it away, that kind of money, you'll have more than, $4.5 million at the end of 40 years. Wow, what an incredible difference. And again, this is compounded interest as opposed to simple interest. So you can see the huge, huge savings here with just a very small amount of money. And you know what? Once you start saving money, when you're putting money away there and you're starting to live that frugal lifestyle, you really love it. You enjoy it, and it becomes so wonderful, and it does make you happy. So you want to have good money management. You want to pay yourself first. So when you watch the video of the richest man in Babylon, you will see that that was important. He paid himself first. And you really cannot manage anything without measuring it, right? So we have a business model that we use to try to manage our business model, right? To find a scalable and repeatable business model. We have a business model canvas that we work with. We also, as we get further along, we into some of the other courses in the entrepreneurship program, we have a feasibility study that we write. So it's a plan that we work towards. We may devise a business plan as well, with all those components put together, but it's a plan. So we need a plan to work towards. The same thing with our wealth. We need a plan so that we can measure it and make sure that we're achieving it over time. So we want to create a budget. So please download that budget and start working with it and start seeing how you can live that frugal lifestyle so that you can still enjoy many, many things. You don't have to have, $50 bottle of wine. You can have an $8 bottle of wine or a $10 bottle of wine once in a while instead, and it does make a big difference. Okay, so now when I want to make a new purchase, what I do is I take out my personal income statement and balance sheet and decide whether or not I want to make that purchase. I also look at my assets. I look and say, what of my assets will pay for this new purchase? I don't just plug it in. I don't take away from my savings. I still save what I save every month. I still put that away. So I don't want to diminish that in any way, but I need to look at my assets and say, what do I have? Do I need to purchase a new asset that doesn't affect my income and that will generate more income for me to pay for my new purchase? And that's how I approach it. And that is my key success formula for creating wealth. So here we, when we're earning income, so here, as I had mentioned before, earning income and exchanging your time for money, right? So what is that? You're working for money by exchanging time for money. You're working on maybe an hourly pay scale, exchange time for money. You're working for money as opposed to having money work for you using your assets. So here, the power of assets, again, assets minus liabilities equals your net worth. And that's a focus that you want to pay good, close attention to. As I mentioned before, I use my assets if I want to buy a car, I want to buy a house, I want to buy a business, but these are also ways that I can use these to be assets. So typically, a car is not an asset, and a house is not an asset, because a car is a liability. I have to pay for it every month, right? A house, I have a mortgage payment every month. That is not an asset unless I rent out that house. I go on vacation maybe 2 months out of the year, and I rent my house out for those 2 months, and that will pay the expenses for the year. And I've actually done this for the year for that house. Now that house becomes an asset. My car, if I do Uber, Lyft, if I rent the car out, then that becomes an asset. So that changes the equation. It's no longer a liability, but a car and a house is a liability on a monthly basis until it earns money for you, then it becomes an asset. Now, you may say, well, if I go and sell the house and I have equity in that house, then it's an asset. At that point, it's an asset, yes. But up until then, it is not, until you have sold it and you have those dollars in your pocket. Okay, businesses are good for creating assets. Okay, so you're running a business, and as long as it's profitable, it is an asset. We want to take those into consideration. So I hope you enjoyed this. I want to I'm going to go into the last module in a separate video just because I'm keeping with the modules here with the videos. So please go ahead and complete the final exam review sheet for module 15 before we go into that final module. You can add the financial information there. I want to thank you, and I hope you do consider really taking hold of your own financial wealth and working towards becoming financially independent.